Welcome back, friends. It's always great to have you here. Today's video is not about a specific trading strategy, so don't think of it as a strict rule-based system. Instead, consider this as a helpful trading tip, something you can add to your own trading toolbox. Right now, I'm looking at the BTC/USD chart on the 1-minute time frame. This means we're focusing on quick price movements, perfect for scalping and short-term trades. I'll be sharing some insights based on what I see on the chart, so stick around. It might just help you refine your own trading approach. Let's dive in. If you take a closer look at the chart, you'll notice that I've kept things super simple by adding just two indicators. Both are exponential moving averages, EMAs, which are great for identifying short-term trends. Here's how I've set them up. 8 EMA, green. This is the faster moving average reacting quickly to price changes. 34 EMA, red. This one moves a bit slower, giving a broader view of the trend. Now, my trading approach with these EMAs is pretty straightforward. For a buy trade, I usually enter when the green 8 EMA crosses above the red 34 EMA. This tells me that the short-term momentum is turning bullish, and it's a good time to look for long opportunities. For a sell trade, it's just the opposite. When the red 34 EMA crosses above the green 8 EMA, it signals that the bears are taking control, and I'll look for short trades. Of course, I always keep an eye on price action and avoid trading in choppy markets, but this simple setup has helped me find some clean entries. If you take a look at the chart, you can see that the market has just made a sharp move downward, following a clear downtrend. But right here, something interesting happens. The market starts to show signs of a potential reversal. Now, how do I confirm this reversal? It's all about reading the candlestick patterns. First, notice this Doji candle. This type of candle forms when the opening and closing prices are very close, creating a thin body with wicks on both sides. It usually appears when the market is indecisive, signaling that the selling pressure might be losing steam. Next, right after the Doji, we get a hammer candlestick pattern. This candle has a small body and a long lower wick, which tells a clear story. And it appears at the bottom of a downtrend and signals a potential trend reversal. So what does this hammer really mean? Well, during that candle, sellers initially pushed the price down, continuing the downtrend, but then strong buying pressure stepped in, pushing the price back up toward the candle's opening level. This shows that buyers are regaining control and the downtrend might be coming to an end. It's a classic bullish reversal signal, especially when it's followed by a green candle, confirming that buyers are ready to take charge. This kind of setup can give us high probability trade entries. But here's the thing. When I opened the chart, I realized that I had already missed the perfect trade entry. It happens sometimes, and it's always a bit frustrating because setups like this can lead to easy, high probability profits if caught at the right moment. See, when you spot a doji candle followed by a hammer candlestick pattern, it's like the market is giving you a clear signal. The sellers are losing strength and buyers are stepping in to push the price back up. It's one of those moments where if you act quickly, you can catch the reversal early and ride the momentum for a solid profit. That's why it's so important to stay alert and confident when you see this pattern. The combination of indecision, doji, followed by strong buying pressure, hammer, is a powerful entry signal. So here's my tip. Whenever you spot a doji followed by a hammer candle, don't hesitate. Take the trade with confidence, set your stop loss below the hammer's wick, and let the market do its thing. Trust the pattern, manage your risk, and you'll often find yourself in high reward trades with less stress. So here's what I'm planning to do now. I'm going to wait for a proper retest before jumping into the trade. Patience is key when trading, and waiting for confirmation can save us from false breakouts. If you look closely, you'll see that the price first touched the 34 EMA, red line, and then pulled back to the 8 EMA, green line. This kind of EMA retest often acts as a support zone, especially when the price respects these levels. Now here's where it gets interesting. The price is trying to push higher again, and I just noticed something important. White Marubozu candle is starting to form right here. What's a White Marubozu? It's a single candlestick pattern that usually appears after a downtrend or a retest, just like what we're seeing here. It's known for signaling a bullish reversal or trend continuation. This candle has a long bullish body with no lower shadow or wick. In simple terms, it means that the buyers were in full control from the moment the candle opened until it closed. There was no hesitation, no pullback, just pure buying pressure. A White Marubozu tells us that the bulls are gaining strength and are likely to push the price even higher. It's like the market saying, we're done with the retest and it's time to move up. So if this candle closes strong and the price stays above the 8 EMA, it'll give me the confidence to enter a buy trade, knowing that the odds are now in my favor. So after seeing all the confirmations, I confidently decided to take the buy trade. This kind of setup is a great example of how waiting for a retest and confirmation can lead to higher probability trades while avoiding unnecessary risks. You can see the market is moving exactly as I expected. The price is climbing steadily, respecting the EMAs and following the bullish momentum. This is the kind of price action we love to see after a strong setup like this. Now, what's my plan? It's simple. I'll stay in the trade and let the profits run as long as the market continues to show strength. There's no need to rush or close the trade too early, especially when the trend is clearly in my favor. But of course, I'm always watching for reversal signals. If you look closely here, you can see the formation of a hanging man candlestick. This is an important pattern to watch, especially when it appears after a strong uptrend like this. It's basically the bearish equivalent of a hammer candlestick, but instead of signaling a potential reversal from a downtrend, it appears at the top of an uptrend. The structure is quite distinct, a small body at the top with a long lower wick and little to no upper shadow. At first glance, it might look like that the bulls recovered well, but the large lower wick is the real giveaway. It highlights the fact that selling pressure is creeping in, even though buyers try to regain control. When a hanging man appears at the peak of an uptrend, it often signals a potential trend reversal, or at least a pullback. I'll closely watch the next few candles for confirmation. If the next candle is red and closes below the low of the hanging man, it'll confirm the bearish reversal, and I'll consider exiting the trade or even looking for a sell opportunity if the overall trend shifts. This is why it's so important to pay attention to candlestick patterns. They give us early clues about what the market might do next. All right, take a look here. You can see that a black Marubozu candle has just formed after the uptrend, and that's a pretty strong signal of a potential bearish reversal. It's a solid red candle with a long body and no upper wick, meaning the price opened at the high and closed at the low without any hesitation from the buyers. This kind of candlestick reflects strong selling pressure, showing that the sellers were completely in control during that time frame. So what did I do? I didn't want to take any unnecessary risks, especially after such a clear reversal signal. So I decided to exit the trade right here and book my profits over $1,000. But here's something important to note. Even though this bearish candle suggests a reversal, there's still a chance the price might go higher. Why? Because the 8 EMA is still above the 34 EMA, which means the overall trend is still bullish. This pullback could just be a retest of the moving averages before the price bounces back up. Trading is not just about entering trades, but knowing when to exit and protect your profits. That's how you stay consistent in the long run. I hope you found these tips helpful and that they add value to your trading journey. If you enjoyed the content and want to see more videos like this, please don't forget to subscribe to the channel so you never miss an update. Like the video if you found it useful. It really helps the channel grow. Thanks for watching, and I'll see you in the next one. Happy trading.